Welcome, everyone. I'm Liz McCormick, and I'm glad to be hosting this panel on managing rising rate environment issuers, how it affects their maturity profile, and a little look at funding risk down the road. So thank you all for being on the panel. I'm going to introduce our guests. We have Rod Balkwill, who's Director of Treasury Management Branch of the Government of Saskatchewan, Nicoleta Oprea, Director of Capital Markets at the Government of Manitoba. And we have Mike Manning, who's Executive Director and CIO of Capital Markets at the Ontario Financing Authority. So thank you all for being here. We have so much we could talk about. We're going to try to get in as much as we can in 25 minutes. And, I hope to have this be interactive. So I'm going to, call on folks with questions. But then if someone replies and someone else would like to weigh in on that, please feel free. Rod, I think I'm going to start with you. Obviously, we have not only very flat curves, we have inverted yield curves. We have what seems like a global rising rate environment. And I know it might seem that, what many people talk about is, it's locking in long-term rates because they're so low and lower than short-term rates because curve is inverted is a great thing. But I'm sure, and I know at this point in your fiscal year, you're not borrowing, but overall in your trajectory over recent years, I know you borrow all across the curve. So can you talk a little bit about, even with inverted curves, why are there reasons to, borrow short? And is part of that from investor demand?
Of course, Liz. Thanks very much for the question. And I think you nailed it in terms of the activity in the curve and how much it's moved around, and obviously the increase in rates and the steep inversion of the curve. It's difficult really for treasurers to I guess try to play that inversion or future rises in interest rates. At the beginning of each year, we set a plan. Both on term, on the amount, of course, that comes from the budgeting process, and then also different levels of currency exposures we'd like to have. And we generally tend to follow that throughout the year. And of course, different parts of the year will provide opportunities in different areas of those buckets. So we generally tend to follow investor demand throughout the year and hope to fill all of those buckets as the years go by, or as time goes by throughout the year. We have, for example, short-term debt is generally used to fund operating deficits. And I don't mean short-term as in floating rate, but under 10 years, we generally look at that term for operating debt. And then our capital program for either infrastructure for government or our crown corporations, particularly our power company who's building transmission and generating capacity, will go out longer parts of the curve. And it generally is difficult in that environment to try to change your techniques based on where the curve is or where you think it's going, because of course that's a very difficult idea to predict. So we tend to try to get in on the average, get into the market several times of the year. Reopening bonds allows us to do that, to kind of smooth out the interest cost that we incur throughout the new interest costs that we incur throughout the year in the borrowing program. But I will say it does create some interesting dynamics with investors, because I'd say they're more influencing. They're always influenced where we would issue or their demand is, but I think where investor demand is probably a bigger piece of the puzzle this time around.
Great, thank you. And Mike, I wanted to come to you next. And if you could talk a little bit, I know, you have an average maturity profile of your debt program. I'm sure you go through it at the start of the year and monitor it. And could you give us a sense, especially with this environment, where it is relative to history? Are you a little bit longer, your average maturity profile over recent years, shorter, and why? And is the shape of the curve or the rate environment have any, backing for why that's changed?
Yeah, we do a fair amount of analysis at the start of the year, where we kind of look at our debt maturity profile and refinancing risk. We also look where we think demand is going to be. As you know, demand is always larger in the short part of the curve. And typically we come up with an average term we think we'll probably achieve over the course of the year. And the upper end of that range, the analysis this year was about 14.6 years. That's a bit on the high side. I think we've, I think the highest average maturity we ever had is about 14.5 years, which we've done a couple of times. So we're quite, we're generally, when we look at that profile, we're more content to be at the upper end of the curve than at the lower end of the curve. And this year has been quite surprising. We've actually right now, again, it's the year's not over, but we have an average term right now of about 16.9 years, which is really long. And I think that's largely been driven by investors. I think investors have been, coming to us quite often with carve-out orders, large orders, and I think it's driven, partly by liability-driven investors who are seeing higher rates than they've seen in many years, and I think we've kind of seen that happening, and it has been beneficial for us in terms of extending the term of our borrowing program.
Great, thank you. And Nicoleta, I wanted to come to you. We were talking earlier that it's a little calm today, but I would say this year has been very volatile in debt markets, even for reporters like me keeping up, with from one day to the next. And I know, like Mike and Rod have already touched on, you folks are not out there timing the market, but in volatility and when we have these, like we had the pandemic crisis, are there any things that you can do, in your debt management program, whether it's maybe trying to get ahead of your financing for the year or, I guess like Mike mentioned a little, go where there's investor demand, that how it's possible to be somewhat nimble and how you deal with kind of volatility?
Well, similar to other provinces, we do respond to investors' demand. And what we've heard from investors is that liquidity is very important, even more now in this volatile environment. So we're going to continue to focus on building good benchmark size bonds. And the focus for the domestic market is 10 and 30-year part of the curve. So with the flatter yield curve, like you mentioned, inverted yield curve, we will end up borrowing in the flatter part of the curve. When it comes to the shorter end of the curve, I mean, we've always left that part of the curve to borrow in the U.S. market. Goal is to be in that market once a year. However, it is our dependent, so we do leave room in our shorter maturity buckets for that, such as 5 and 7 year. And with the volatility that we've seen in the market, I mean, we've what we have done, and this was at the start of the pandemic, is that we have increased our liquidity position. So we have 6 months of cash on hand at any one time, and we'll continue to keep a healthy liquidity on hand until we feel that some of the risk factors, inflation, geopolitical issues, market volatility are reduced. There is a cost associated with this. However, it does give us the flexibility to issue when the demand is there. And some of these costs are offset by the higher rates in the front end of the curve where the cash is invested.
Great, thank you. And Rod, I wanted to come back to you. Part of the title of our panel gets to, looking at funding risk down the road, which for me, I always think about it as rollover risk. And I know you're managing, getting your financing done in the most cost-efficient way, but you're always looking down the road of where the rollover risk pain points may be. And I know, that's always on your mind, but I wondered at this juncture, any thoughts on potential rollover risk, whether it's higher rates, lower rates, or, how you kind of factor that into your programs?
Well, there's, I think, two components to that, Liz. There's the rollover risk in terms of what rate are you going to be refinancing at, and then is there going to be difficulty in refinancing? And the first one is more likely to be considered, where a rate's going to be in the future. And so we've always, in our province, biased towards longer dated maturities just for that purpose. We do have more capital projects than operating deficits in terms of our funding requirements, so we do go out longer. But I'd say there is a bias towards locking in rates longer understanding. It gives more predictability to your debt and lowers the risks of you refinancing at a higher rate. That becomes a little bit more tricky, thinking about it differently when the curve's inverted. And I'd say at a time like this, we're almost finding that the rollover risk is, looking out is that potentially going shorter is actually maybe can be beneficial. And part of that is due to there's some positive correlation we're seeing between government revenues and interest rates. When inflation is higher and the economy is doing well, short-term rates are higher and generally revenues are higher, but also short-term rates are higher. So on the margin, I would say, again, we're not predicting where things go, but on the margin, in times like this, we may consider borrowing shorter in anticipation of those shorter rates possibly coming down in the future, and being reinvest at lower rates. We're in this weird period too, where some of our debt is maturing now after years of maturing at lower rates or higher interest rate debt maturing and being borrowed at lower rates. Now we're seeing higher rates. So there is a little bit of pressure on interest on debt as that takes place.
Great. Well, Rod, you led me into my next question, which I was going to come to Mike about the interest expense on debt, which I know is an important aspect of all of your work. And I think, Mike, it may be the fourth largest expense where you are. And I wondered if you could talk, like Rod touched on, it was actually during the pandemic, it was kind of maybe not surprising to you all, but surprising to some that even as there was a lot of fiscal spending and a lot of issuance globally from provinces as well as federal governments, that the interest expense on debt went down because the Fed and other central banks were lowering rates and we had very low rates. So it brought the interest expense down. I'm wondering, Mike, if are we maybe at an inflection point? I know you don't predict rates, but can you speak a little bit about the interest expense on your debt, how you manage it, and any thoughts on looking into the future?
Sure. Interest on debt, you're 100% right. It is our fourth largest expenditure category. We have the health sector and education and children's and social services that are ahead of it. So those top three are about 63.3 billion and account for about 63.3%, 125.9 billion, sorry. I correct myself there. So in IOD, we're currently forecasting 13.6 billion, about 6.8%. So it's smaller, but still important category. So we do spend a fair amount of time trying to forecast interest on debt, but I will say, and I'm sure true for the others as well, we try to be very conservative and prudent when we forecast interest on debt. And for example, the assumptions we make about Ontario spreads are quite large, and we're pretty confident that the numbers will come in lower. So that's one of the elements that we do use to try and manage the IOD, make it something that we can hopefully outperform. Our IOD forecasts are driven by private sector forecasters. We don't really rely on private sector forecasters, but to be 100% candid, forecasting interest rates even by the best is very challenging. And over time, we've seen those interest rate forecasts to be quite difficult for investors to actually beat. So we have seen an increase in interest rates. We've had 300 basis points of policy rate changes since the beginning of March, which is quite phenomenal. We're probably going to have more increases. So that's really very unusual. This is something that happens maybe once in a generation. We have these type of changes. So when our first quarter finances came out, we did have a small adjustment. We went from 13.5 billion IOD forecast to a 13.6 billion IOD forecast. But I would like to just comment that, forecasting interest on debt or your annual interest charges is not independent of your fiscal situation. So to the extent the provinces or Ontario were to have substantially better fiscal numbers, then the deficit would be lower, which feeds through to the borrowing program. So it's quite likely that it's sort of an offset to the pressure of interest rates in terms of increasing IOD, and the potential is certainly there to have better performing IOD numbers than initially forecast.
Interesting. So there's a lot involved with it. And given that, and it's such an important topic, and Rod kind of mentioned it as well. Nicoleta, can I come to you on the same topic, like interest on debt, how it weighs into your work and what you see a little bit on the outlook if you do?
I mean, the current environment is definitely, adding pressure to public debt expense. When we do look at budgeting and forecasting the public debt expense, Manitoba too has a fairly conservative forecast when it comes to forecasting the expense. However, interest rates, as Mike mentioned, have been going up in the last little bit here. So we are seeing the pressure to public debt expense. And from a Manitoba perspective, I mean, it's not so much in the current fiscal year. We started out the year with, in addition to the planned 6 months of pre-funding that I mentioned earlier, our cash at year end was also higher than what we forecasted. So that gives us a little bit more flexibility in terms of when do we need to go to the market and borrow, and the impact that will have on current year public debt expense. So our borrowing, it is pushed out in the latter part of the year, and we are seeing better revenues. Our cash numbers coming in, similar to other provinces, is higher than what we are forecasting. So current fiscal year, there are offsetting factors that offsetting to the higher rates that we're seeing. However, future years, next fiscal year, we can see more pressure added to public debt expense. I mean, our forecast is going to be conservative, but it is going to be added pressure to public debt expense.
Thank you. And changing course a little bit, Rod, I want to come to you with a broad topic that especially during the pandemic, I know borrowing itself was challenging, let alone what rate it was at. And I'm wondering, and Nicoleta earlier talked about, buyers like liquidity, they go to the liquid points on the curve. And I wondered, Rod, if broadly, do you feel like conditions in the debt market are back to pre-pandemic levels, or is there still some overhang and it's not quite as clean and efficient? I'm curious what your thoughts are on that.
Yeah, the investors like us, we're the other side of the equation, but investors have been hit with a lot of volatility. They've had, I think Mike alluded to it, a generational increase in interest rates, maybe even more than that, in terms of the speed of the increase and the resolve of the central banks. And we've got the added effect of quantitative tightening, where they're not buying back bonds, they're letting them roll off their balance sheet at the Fed. So the investors have been buying bonds and seeing them go down in value almost immediately afterwards. And that's just on the rate side. The credit side is very problematic too, and we don't have to talk about all the things that are going on in the world. So we're seeing the investor appetite, as I mentioned, really drive where we issue. We have to be respectful of that. Bigger or more liquidity can really make it a little more difficult for the smaller borrowers. And this year we are a smaller borrower, so we really do feel we need to move to where they're looking. And if you were to, it's a lot better than it was 2 years ago, but I don't think it's much better than it was a year ago. Right now, I'd say it's still. A year ago it was purely pandemic. Now it's this interest rate effect, and it's taken taken our shop, and I think a lot of investors a while to realize or to accept the resolve of the central banks to keep raising rates. And it'll be interesting to see where it ends out, but that's making it quite difficult for investors. So I'd say we're probably 7 out of 10, 6 to 7 out of 10 compared to a normally functioning market, if that's a way to measure it.
Great, thanks. Mike, kind of not on the same question, but in perspective, I know you've been doing what you do for a long time. How would you put, what you've all been through in the last, 2 years or so, the pandemic, now we have a persistent inflation problem globally, like Rod mentioned, central banks, and you all did tightening overall, balance sheets unwinding, perspective relative to the global financial crisis, how difficult it's been to be a provincial debt manager?
Yeah, well, it's always challenging, because we do have a large borrowing program, and the pandemic was quite challenging in the sense that there was a dislocation in markets at the start of the pandemic, which made borrowing, even short-term borrowing, quite challenging. So, the federal government did provide support, and the markets got functioning again. So I think we kind of weathered that storm. We borrowed over $60 billion that fiscal year, so that's all-time high by us by a large margin. So we're able to get the money in the door, and I think we do benefit from having a highly liquid borrowing program. Now, what's been somewhat beneficial compared to the global financial crisis is that credit markets have held in. We haven't had a lot of defaults, etc., that we had back in the global financial crisis. So I would say that the global financial crisis was probably worse. Again, that's just my opinion. Where we are now, it's challenging because we always say that you don't really want to be borrowing at a time when central banks are in an aggressive tightening mode. And that's exactly what we have now. The fear is that investors kind of sit on the sideline and say, I don't want to invest any more money until I see that interest rates have peaked. So, but we have been getting issues done. But as Rod was saying, it certainly is challenging. You don't really have the luxury. We talked a little about you could sort of front end load your borrowing program, but when you have to kind of get ahead of the central banks, but when you're a large borrower, that's kind of short, so you can't really do too much of that. So I would say everyone is kind of doing their best and kind of just coping with sort of the circumstances that we currently have.
Great, thank you. And Nicoleta, one thing we haven't talked about, I believe you have some international, issuance, some foreign demand for your debt, and I wonder, has that changed? Has the maturity profile of what they're leaning to, or changed at all, or could you speak to that a little bit?
We have seen some shift in terms of international issuance. I mean, when the pandemic hit that year, there was hardly any international issuance that we did in terms of euro and Aussie, where we've seen private placement interest. Last year, however, was much better. We had a 40-60 split between domestic and international issuance. We were able to access the U.S. market, so much better last year's. However, we have seen a shift again this year in regards to arbitrage. We do go to international markets, one-off private placements, as well as the U.S. And the interest has decreased. Now, this is in large part of the arbitrage, but also I believe a large factor is similar to even domestic issuance is the volatility in the market has reduced demand that we see from international investors. With central banks raising rates, we're seeing investors on the sidelines and waiting to see just how much higher rates are going to go, and not willing to participate and put money to work at this time.